Imagine looking at a company that just posted a brutal $83 million quarterly net loss on merely $46 million in revenue. Your very first instinct, run for the hills, call it a cash furnace, a value trap. But what if that obvious conclusion is completely, dangerously wrong? What if I told you that this exact same company is quietly sitting on an $11.8 billion treasury of liquid digital assets and management just authorized a $4 billion stock buyback? How does a company hemorrhaging cash on paper turn into one of the most talked about setups on Wall Street? And why is the so-called smart money aggressively buying while everyday traders are running scared? Welcome back to Calvin Mateo, the channel where we cut through the noise and find the stories Wall Street is missing. Today we are diving deep into the bizarre, high-stakes world of BitMine Immersion Technologies, ticker symbol BMNR, and by the end of this video, you'll understand exactly why this stock has everyone arguing. Before we go further, if you love deep dive breakdowns like this one, do me a quick favor and hit that like button and subscribe. It genuinely helps the channel grow. Alright, let's get into it. Here's the first thing you need to understand. This company has completely abandoned its identity as a traditional cryptocurrency miner. They are no longer just plugging in machines to solve algorithms. They have transformed into a highly leveraged, institutionally backed digital asset trust. They are holding capital at a scale that is almost impossible to comprehend for a company of this size. That sounds impressive, until you look at what's actually happening underneath the surface and see exactly what they're holding. Management calls it the alchemy of 5%. Their publicly stated aggressive objective is to acquire exactly 5% of the total global Ethereum supply. And here's the wild part, they are actually pulling it off. As of the latest data, BitMine's treasury holds a staggering 5.79 million ETH. That means a single publicly traded company has essentially cornered 4.8% of the entire global circulating supply of the world's second largest cryptocurrency. Think about that. They are 96% of the way to their ultimate finish line. They've built an $11.8 billion financial fortress made of crypto, cash reserves, and targeted moonshot investments. But here's where the story starts to get complicated, because Wall Street's algorithms have no idea how to price something like this. We have a massive valuation paradox on our hands. If you pull up BMNR on a standard stock screener, the traditional operating metrics look absolutely terrifying. You'll see extreme negative margins and a mind-boggling negative EPS of negative $128.25. But applying standard GAAP accounting to a digital asset trust is like trying to measure the speed of a sports car with a thermometer. It's the wrong tool for the job. When you switch to the metrics that actually matter for a trust, something interesting happens. BMNR is trading at a price-to-book ratio of roughly 0.8 to 0.9 times. In plain English, the stock is trading at a 5 to 11% discount to its net asset value. You could be mathematically buying $1 worth of Ethereum for about 90 cents. But before anyone gets too excited, there's another layer to this, because holding billions in crypto doesn't magically pay the company's bills. This is the hidden trap that destroys most companies that try to hold crypto on their balance sheet. BitMine recently raised capital by issuing 9.5% Series A perpetual preferred stock. That specific financing created a massive $40 million annual dividend obligation. Now here's the danger. If BitMine simply locked their 5.79 million Ethereum in a cold storage vault, it wouldn't generate a single penny of cash flow. They'd eventually be forced to liquidate their holdings or dilute common shareholders just to pay that $40 million bill. So how did they escape the trap? Management anticipated it. They took 4.9 million ETH, about 85% of their entire portfolio, and deployed it into staking through their Maven platform. That staked Ethereum is now acting as a massive cash flow engine, projecting somewhere between $247 million and $299 million in annualized revenue. In one move, they structurally neutralized their balance sheet cash burn risk. The debt is covered, and the rest of the treasury stays completely untouched. And that brings us to the question every investor actually cares about. What could possibly push this stock price higher? A big part of the answer lies in the $4 billion share repurchase program. This isn't just a corporate PR stunt, it's an aggressive, mathematically ruthless float reduction strategy. Management intentionally slowed down their new Ethereum acquisitions so they could funnel that capital directly into buying back their own stock. In July alone, they retired 11.6 million shares, with 6.1 million of those scooped up in just the past week. By constantly reducing the number of shares outstanding, they're forcefully pushing the intrinsic value of each remaining share higher. In fact, this active float compression accounted for 86 to 88% of the weekly increase in BMNR's Ether per share value. In simple terms, they're making each investor's slice of the pie bigger every single week. At first glance, this looks like a straightforward growth story, but one detail makes it much harder to ignore, because when you look at who is actually buying, the picture changes. While retail traders have been notoriously impatient, frustrated by choppy price action and high daily volatility, the so-called smart money has been quietly and aggressively accumulating. Top-tier institutions have been happily absorbing the shares that retail keeps selling. Citadel Advisors boosted their stake by over 92%. Susquehanna added 5.15 million shares. Weiss Asset Management completely backed up the truck, increasing their position by an astronomical 363.6%. We even saw the California Public Employees Retirement System initiate a brand new $14 million position. Now, to stay completely objective, because that matters on this channel, it's worth noting that Cathie Wood's ARK Invest recently trimmed their exposure, selling roughly 120,000 shares, even after previously calling the strategy an exponential opportunity. So it isn't unanimous, but the broader institutional momentum leans heavily bullish, and it aligns with a Wall Street consensus target of around $27.65, which, if it ever played out, would imply something like 55% upside from current levels. A huge if, but a fascinating one. This institutional backing is a serious safety net, but if we're going to understand this stock properly, we have to bust a major myth that's spreading all over social media right now. If you spend 5 minutes on financial forums, you'll see retail traders screaming about an imminent short squeeze. And yes, it's true, BMNR has 46.31 million shares sold short. That sounds explosive, but you have to look at the volume. The average daily volume is a massive 35 to 40 million shares. That means the days to cover ratio is barely 1.1 days. If the shorts want to exit, they could cover their entire position in a single afternoon without triggering any parabolic spike. So a traditional short squeeze? Highly unlikely. The real squeeze here is the corporate buyback squeeze, that slow, relentless shrinking of the float over time. But look closer at the options picture. There's heavy call resistance capping momentum between $17 and $18. And yet, the option scanners just picked up an anomalous sweep of 1,895 call contracts at the $20 strike, expiring on August 28th. Someone with deep pockets just spent nearly $170,000 in premium, betting that this stock violently breaks through that $18 ceiling in the next few weeks. So who's right, the cautious shorts or the whale rolling the dice on a breakout? With a clear catalyst and big money-making moves, let's talk about what disciplined traders are actually watching on the chart. And remember, this is analysis, not instruction. BMNR is a high beta, extremely volatile momentum vehicle. It routinely swings $1 or more intraday. Right now, the macro trend appears to be in a recovery phase, with the stock consolidating in a tight channel. It has reclaimed its 20-day and 50-day moving averages, which many traders view as constructive. For the trading window many are watching, roughly July 31st through August 6th, the levels in focus look like this. Traders eyeing a long position are watching a scale-in zone between $16.50 and $16.90, right near that 50-day moving average support. A first area of interest for taking profits sits between $17.96 and $18.31, the upper Bollinger Band, and a heavy resistance zone where market makers tend to hedge aggressively. If price were to break through, the next zone of attention runs from $18.95 up toward that $20 psychological level, aligning neatly with the option sweep we just discussed. And on the downside, the level many are treating as a line in the sand is $15.40. A daily close below the 20-day simple moving average would, for a lot of traders, signal that the short-term bullish structure has broken. None of this is a recommendation. It's simply the map the market seems to be trading around. But maybe you're not here to day trade this at all. Maybe you want to buy, hold, and let the treasury grow over the next few years. So what would you actually need to watch? If you're a long-term investor, you can throw the standard price-to-earnings ratios out the window. They just don't apply to this asset class. Instead, there are 3 fundamental metrics worth monitoring. Number 1, the asset floor. The survival of BMNR's net asset value leans heavily on spot Ethereum, staying comfortably above roughly the $1,200 to $1,400 threshold. Hold above that, and the balance sheet looks resilient. Number 2, yield defense. Every quarter, you'd want to verify that their staking revenue safely covers that $40 million preferred dividend obligation. As long as they never have to sell their principal to pay their debt, the core thesis stays intact. And number 3, float velocity. Keep an eye on the weekly 8K filings. As long as management keeps aggressively executing that $4 billion buyback, they're effectively acting as a synthetic engine, pushing the Ether per share value higher over time. Which brings us finally to the honest risk versus reward picture for BitMine Immersion Technologies. An unconventional asset demands an unconventional lens. Yes, on paper, this looks like a deeply unprofitable tech company. But underneath, it's an $11.8 billion digital asset fortress that appears to be trading at a discount to what it holds. When you combine the staking yield that helps protect the downside with the aggressive float reduction squeezing the upside, the risk-to-reward profile becomes genuinely asymmetric, and that's what makes this one of the most fascinating setups in the market right now. But before we wrap up, the disclaimer that actually matters. I am not a financial advisor, and absolutely nothing in this video is financial advice. Everything here is for educational and entertainment purposes only. Cryptocurrency and crypto-linked stocks are extraordinarily volatile, and you can lose money, potentially a lot of it. The figures discussed here should be independently verified, and past performance never guarantees future results. Please do your own research and consult a licensed professional before making any investment decision. So here's my real question for you, and I genuinely want to know, do you think BitMine's strategy of hoarding 5% of all Ethereum is visionary genius or a house of cards waiting for one bad crypto winter? Drop your honest take in the comments below. I read every single one, and the best answers spark the best conversations on this channel. If this deep dive brought you value, smash that like button and subscribe to Calvin Mateo so you never miss the next breakdown of the stories Wall Street conveniently overlooks. I'll see you in the next one.